Alright, so now we're going to look at how to record the sale of a fixed asset. And there are really three steps that we need to consider. First, you need to have the accumulated depreciation account brought up to date. So if you sell as of the end of March, then you need to depreciate through the end of March, and you need to record the related expense through that time period. So depreciation has to be up to date. Once that's done, then you can determine the book value, and then you're going to compare the selling price that you're receiving to that book value to determine whether or not, yay, there's a gain, or, wah, there's a loss. Alright, so how are we going to do this? Let's come up with an example. So let's assume we have an asset that initially cost us $1,000, and we update the depreciation. We're going to just take that as given that the accumulated depreciation balance is current, and it has a balance of $720, and we've been offered a price of $300. So what does that mean for us? Well, we have to think about the book value. We have to decide whether or not there's a gain or loss, and then finally we have to record the entry. So book value, how do we compute book value? Do you remember? It's cost minus the balance in the accumulated depreciation account. So the $1,000 of cost minus the $720 in the accumulated depreciation, and we've got book value of $280. Now we've been offered a price of $300. Do we have a yay, we're happy, we have a gain, or wah, we're sad and we have a loss? Well, because the price that's being offered to us is $300 and our book value is only $280, yay, we have a gain. Now, how are we going to record the entry? We need to accomplish a few things. We need to get rid of the asset account. We need to get rid of the related accumulated depreciation account, because that asset and its accumulated are going to go away. We're selling the asset. We're going to have to record that we're receiving some cash, and then we've got to record the related gain. And in this problem then, we would debit cash for $300 because that was the price that we've received. Accumulated depreciation is a contra asset account, which means it has a credit balance. So to eliminate that balance, we record a debit to accumulated depreciation for $720. We have to credit the equipment account for $1,000 at its cost to make that asset account go away. And then that leaves us with the gain on sale of $20. And gains act like revenues. They increase the value of the business. They're not revenues because they're not operating items. We're not in the business of buying and selling our equipment. That just happens to be something we're doing on the side. But it has a credit balance. It has an increasing value to our business. Credit balance for gains. Now, what if instead of a price of $300, what if the price was $250? Well, the book value would remain unchanged, the $1,000 of cost minus the $720 in accumulated depreciation. So we have $280 of book value, but now we're only getting a price of $250, and the book value is $280. So we're taking a loss of $30. And so to record that entry, we're getting cash now of only $250. We still have to debit accumulated depreciation for $720. Losses act like expenses, so we would debit loss on the sale for $30, and then we would credit equipment for $1,000. And that's how we record sales of long-lived assets.